Hey guys, TommyBryson here, and today I want to take a look at a book that's actually legendary, and it's called A Random Walk Down Wall Street by Burton Malkiel. Now this book right here is a book that literally exposed the entire industry by saying, hey, professionals cannot do better than the average, so you might as well not pay them and just go ahead and get the average market return every single year. Now while reading this book, I found 5 main nuggets I want to share with you guys today, but in reality, I actually read the audiobook. Now to be honest with you, the audiobook was around 12 hours and 13 minutes. So there is no way that this video right here is going to cover every single detail. So if you want to go ahead and read this book right here for free, I have a link down below to Audible, and when you sign up, you get 2 free books, and on top of that, you still keep the books if you cancel either way. That way you get them for free. And the second book I recommend is called The Little Book About Common Sense Investing by John C. Bogle. A great book also on investing and also the average and how to go ahead and invest your money, okay? Now, if you guys are new here, I post videos every single day, so make sure to also subscribe and hit the bell so you're notified. On the top of that, also destroy the like button. Now, the first nugget that I found in this book, guys, is basically the perfect investment strategy. By the way, the author makes it very clear that it's basically impossible to predict the market, and in reality, all those professionals out there is kind of like flipping a coin, and 1 year they're good, 1 year they're bad, but if you can't beat the market consistently, then in reality, your ideas, your whole plan, it can't really be viable. So that's why usually you're better off just going ahead and getting the averages, and that's the entire goal of this video right here, and that's what it tries to teach us. But here are the 3 main strategies when it comes to investing that you're going to see when you are actually investing. The first strategy is called the firm foundation theory. And the idea is that these people right here invest based on, hey, what is the intrinsic value of the stock, the common stock? What is it actually worth when you talk about the assets, liability, its growth potential, its dividends, and also its earnings per share, okay? What is the real value of this stock right here? And then they go ahead and compare the intrinsic value to the market value. Now, if that sounds familiar to you, it's because it comes from this book right here called The Intelligent Investor by Benjamin Graham. And it's a book that basically Warren Buffett wrote himself, and it's a strategy that Warren Buffett himself actually practices. The entire idea is that if I can find out exactly what a company is worth to its core, well, if the market's selling for less money, once I buy it for less, the market will eventually adjust, and that way I'm going to make solid money in the future. And that's how Warren Buffett basically invests today, but in reality, he buys more bigger companies, solid companies, and then holds on forever and only sells literally when something fundamentally changed with the company. And that's why he sold when he sold the airline companies back in 2020. And the second strategy is basically the castle in the sky strategy. And the strategy is that basically, guys, the idea is that people tend to invest and they tend to build castles in the air with not a solid foundation. So at any point it could collapse, but your whole goal of the strategy is to basically go ahead and invest before people start going crazy about an investment. So your goal is to basically go out there and invest based on stories, based on hype, and based on what people, the common person, the average person out there, is going to go crazy about. For example, if you could invest, for example, into Tesla or Amazon before everyone went crazy about it, you would have made a lot of money. But that's how it works. But it takes a lot of psychology and also studying human nature, how people react to things. So it's a lot more based on, hey, what do people think, and not about what the company is actually worth. So basically, it's a lot more complicated, and it also carries a lot more risk. On top of that, the last strategy is basically the greater fool strategy. And the idea is people that invest not because they have like a good foundation of the company, what's it worth, or for example, because everyone's gonna go crazy about it, but in reality, they only invest because they believe that somebody else is gonna pay more money for what they just paid money for, but they don't have any idea why. And that's a lot of people that basically invest into cryptocurrency thinking that, hey, I'm gonna buy it and someone else is gonna pay more money and then boom, I'm gonna get rich, okay? That's the idea. But if you ask me, Tommy, then what's the best strategy here? The answer is, in totality, what you're doing is you wanna combine a little bit of all of these 3. So you wanna buy below intrinsic value. On top of that, you want to buy something that has a good story, a good CEO, a good company, a good record, also a good brand. And that's what Warren Buffett something calls like the moat of the company, like around the entire company that actually protects it from its other brands and competitors. And on top of that, you want to buy something that someone else is also going to pay more money for, because that means it has some type of traction and people are going crazy about it also, okay? So you kind of want like a combination of all 3, but the most important part is, does it actually have some value, okay? Intrinsic value. So firm foundation theory is probably the most important theory when it comes to, hey, what is the company actually worth, and what should I pay for the actual company? And now the second nugget that I actually found in this book is basically a better strategy when it comes to the average investor and how to capitalize on the averages of the market and get the average return every single year. Now, history and math shows us two things, okay? That the best strategy is basically buying and holding for a very long time. And also, diversification is very important, and that way you're not over leveraged on one sector of the market. So the idea is this, guys, okay? When it comes to investing and diversifying, you don't just want to invest, for example, into the S&P 500 or, for example, the total market fund. The idea is you want to have a diversified portfolio, and that way you're kind of like exposed to the entire market, both in the US and outside the US, and also in the different sectors, and that way you get a better return every single year, and you also carry a lot less risk. Now, an application today that does this very well is called Acorns, and basically with Acorns, you invest, for example, into ETFs that are in different sectors, for example, in the real estate sector, inside the US, outside the US, developing markets, also into corporate bonds, government bonds, and that way you're exposed to everything, carry less risk. On top of that, the app does everything for you, okay? On top of that, put a link down below. If you want to sign up, you can always sign up with my link and also get $5. Now, the third nugget that I found in this book is basically a lot of stories about bubbles. Now, bubbles, as you guys know, is something you actually don't want when it comes to investing and also financial markets. The idea is that eventually in financial markets, you get a lot of bubbles that eventually do form, and when they pop, things tend to go down like crazy. For example, you have the real estate bubble, you also have the tech bubble, you also have the South Sea bubble, you also have the Balt bubble that actually went out in Dutch. The idea is that there's always going to be a bubble that happens out there, and the best way to prevent it is to kind of understand that, hey, if something sounds too good to be true, it probably is. And the best thing to do is just stick to the strategy you actually do. Now, a great thing to do that this book talks about is called dollar cost average. And the idea is, if you have, for example, a portfolio you invest into that's very well diversified, for example, Acorns, the idea is don't just put all your money in at once during the good times or the bad times. The idea is you keep investing a small amount of money every single week or every single month, and that way over a long period of time you have a lot less risk, because basically you're buying at both the lows, also the highs, and that way you get the average of what the market was actually giving you during that entire 10-year period or a 20-year period, okay? That way you kind of like not worry that much about a bubble happening when it comes to the entire stock market, because eventually they will form and there will be corrections, but you want to make sure you buy during the good times and also during the bad times also. Now, the fourth nugget I found, guys, is actually what does a professional cost versus what can you actually do yourself without actually acquiring any of the fees. Now, usually when you pay someone to do something for you, you're expecting basically a better result than you can actually get, right? Because if you could do something better, you would just go ahead and do it yourself and not pay anyone else to actually do it. But when it comes to Wall Street and also the entire investment field, the idea is a lot of these guys get paid to do something that is actually mediocre. In the sense you can actually outperform them by just getting the average return every single year in your portfolio and doing it yourself. Because in reality, when you have someone that's in an active fund and basically they're trading a lot back and forth and selling back and forth on all those stuff, usually they're going to charge you 1 to 2% every single year of your portfolio. On top of that, you're going to get a lot of fees with trades. On top of that, you're going to get a lot of tax problems when it comes to capital gains tax, because they're constantly selling back and forth and trying to beat the market. But in reality, again, the best strategy is basically just buying and holding for a long period of time. And in reality, you might say, well, Tommy, paying a person 1 to 2% is no big deal. But in reality, that 1% fee or 2% fee could have to be around 33% of your entire portfolio size in the future. Because think about it, okay, guys? You have a 7% return on average every single year from an index fund, right? Like the S&P 500. But if you have a 7% return and then take away 2% and tax you like 1%, inflation 2%, in reality, all you have left is 2% for yourself. So basically take a third of all of your money. So the best strategy is usually just to do it yourself with just a little bit of experience. And that's what this book provides for you, okay? And that's what I like about this book. You walk away knowing exactly what to do when it comes to investing, okay? And that's why I invest the way I invest also with the app called Acorns, because basically everything is simple. They don't charge me a fee, only like $1 every single month. But in reality, that $1 fee is way better than 1% of my entire portfolio. Because in reality, in the future, when you have 100K, that 1% is like $1,000 versus just a $12 fee every single year. That's a big difference if you ask me. Now, the last nugget I found in this book is basically a strategy when it comes to retiring. Now, usually all retirement strategies talk about, hey, if you're in your 20s, start investing early. But in reality, he also gives a strategy if you're in your 50s or even in your 60s. And by the way, guys, okay, the great thing about the modern world is that basically you can be in your 70s or 80s or 90s and still be able to work, because most of the work out there is no longer backbreaking and labor intensive. So if you can work, highly suggest it. And by the way, it's known that basically if you are working while you're in retirement, most likely you're going to be healthier and also in a better state of mind, because having a purpose to do every single day is actually very helpful to the human person, okay? And overall, guys, the whole concept of this book is that basically it shows you that basically the professionals out there that beat the market maybe once or twice a year, in reality, they can't constantly do it over a long period of time. So you're better off just investing in yourself and getting the average every single year, and that way you don't have to worry about like, hey, but the taxes, but the fee they're charging me. That way you avoid all that stuff, bypass those people, and go right ahead and get all your profits yourself and get the average every single year. And by the way, if you want to do that, I highly suggest giving a call to Vanguard, and they'll help you out with everything. And by the way, if you are in retirement right now or want to retire early or whatever you want to do, the answer is I recommend you get a target date fund that's fully based on retirement, and that way they invest for you. On top of that, once you get closer to retirement, they switch it over into more income basis, and that way it makes you a lot more income, but it also carries a lot less risk. So everything for you is done with a target date fund, and Vanguard has a bunch of them, okay? So take a look at those also and give Vanguard a call. But guys, by the way, I'm not affiliated with Vanguard at all, but they have a lot of features, and they're also very well respected in the entire industry and do a lot of great work, and that's why I recommend them a ton. And on top of that, their fees are basically very low compared to everyone out there. But guys, overall, I highly recommend this book. It was a great book, and you walk away knowing a lot more than you actually knew in the beginning. So if you want to read this book, again, link down below to Audible, but the audiobook is around 12 hours and 13 minutes, so keep that in mind. So read like an hour every single day, and in like 12 days or so, you'll be done with the entire books. But I do recommend take notes while you're reading, that way you remember things, okay? And as always, guys, if you like this video right here, like this video. On top of that, if you're new here, subscribe and hit the bell so you're notified. And also, if you want to talk to me one-on-one, uno, just DM me on Instagram, TommyBryson, or for example, subscribe to my Patreon, link down below. Or if you want to watch another video, basically on another book review on Warren Buffett's book, watch the video right here. And see you guys tomorrow. Thanks for watching, and as always, peace.